All right, folks, here we're illustrating Cloudflare, and we're working with one of our analyst prep program student, Aiden, and we also have our analyst and customer success team here on this call. And I thought it will be interesting or perhaps a good learning opportunity to share what is currently happening with the market, particularly focusing on tech stocks. So here we have Cloudflare, which is down more than 70% from their all-time highs. And Aiden was staffed on a valuation project where he performed discounted cash flow analysis to determine what's the fair value or the intrinsic value of Cloudflare. So what I'm going to show you here is his discounted cash flow analysis to determine if the stock is overvalued or undervalued. And as we went through this process, as I'm auditing his model, you can see that from a terminal EBITDA basis, this is one methodology of valuing a company using discounted cash flow. Look at the share price range. On the low end of this valuation range, he arrived to $11.90. On the high valuation range, $21.70. This is terminal EBITDA method. If I scroll down a little bit more, here's his other discounted cash flow method. This is known as perpetuity method. For those of you in academia, this is the Gordon growth rate methodology. And look at this range, $3.94 a share and $8.50 a share at the high end. But what's important to also understand is the weighted average cost of capital, which is essentially the discounted mechanism, the discount rate that the market is using in the event that Cloudflare would want to raise capital. They'll probably have to raise capital at an 18% discount from their current share price. This is assuming that they want to do a capital raise. They want to issue shares to receive capital and influx of cash from investors. That's what this is illustrating. But what's interesting is when you look at the weighted average cost of capital calculation, this is how you calculate WACC. Look at the main driving factor here is the 30-year, okay, the equity risk premium, and the company's beta. But if we also factor the long-term rate of return of the S&P 500, this is another main driver to calculating your WACC rate when you're performing discounted cash flow analysis. Now, pay very close attention to what happens to WACC when we decide to increase or decrease what the expected long-term rate of return of the S&P 500 is. Before this video, the number was 8.5. And look at his WACC rate right here, cell C91, 15.9%. Depending on the time series data that you're looking at, the expected long-term return of the S&P 500 could range between 8.5% and 11.5%. So if we increase this by just 1%, 8.5 to 9.5, take a look at the WACC. 18.5%. And in addition to that, the 30-year risk-free rate, which is 30-year U.S. government bonds, that number now is 3.81%. And it's actually getting closer to 4%. So if I change this to 4%, okay, my WACC decreases by several basis points. If I increase or decrease my beta, let's change the beta to 1. Look at my WACC. It becomes 9.4%. So what has happened in the last 6 to 9 months, because of the Fed rising interest rates, has created more volatility in the market, which is illustrated with a higher beta of 2.61, has also increased bond yield, now near 4%. And we can also adjust the expected long-term S&P 500 rate to get our equity risk premium, which is the excess return that you're expected to gain in the stock market when you factor in your 30-year risk-free rate. Now, the market is discounting future cash flows of the business for Cloudflare and other companies, but specifically for Cloudflare, 18.2%. Whereas 12, maybe 24 months ago, the beta of a company like Cloudflare would have probably been around 1.5. The discount rate would have been maybe 12%. If the 30-year bond rate, maybe 24 months ago, was around 3%, look at the WACC, 12.2%. Or maybe other investors were factoring a 8.5% S&P 500 long-term growth rate. Look at the WACC, 11%. So what has transpired in the last 12 months due to the raising of interest rates by the Federal Reserve has created a higher cost of capital scenario or environment for companies like Cloudflare. And when you see the valuation up here, okay, if we change this WACC, right, here on the column, this is WACC, this is your discount rate. Let's change this, let's say, to 10%. Look at the share prices. They increase, okay? Look at it from a perpetuity standpoint. Let's change this to 10% as well. Your perpetuity growth rate is out of whack. We got to change this more to maybe inflation, right? And then increase this Aiden by 0.0, maybe 1%. -1. We change this to 10. That would be the implied share price, okay? But the multiple on a terminal EBITDA basis, when these high-level growth SaaS tech companies are in a healthy market environment, that EBITDA number sometimes can reach 15 or 20x. But in the current market environment, right, if we go back to 18, maybe 10x for the EBITDA multiple, because this is if someone buys this company, maybe they'll pay a 10x multiple. And if we change back the perpetuity method, look at the valuation ranges from both of these valuation methodologies, 11 and 21, high and low, 394 and 389 from a perpetuity method. And if I pull back the chart, here's the practical application in this. Here's the chart, right? This company's stock, right, might potentially come back down to their IPO level from 2019. So this stock can potentially come down to maybe $20 or even below that, which would be around $15. So the next 6 to 12 months has a higher probability chance that this stock might potentially trade around $20. And this is due to the higher discount rate. Higher interest rates means the cost of business is going to increase. Volatility in the stock market, illustrated in the form of a beta, also impacts your weighted average cost of capital, as you're seeing right here. And what I was sharing with Aiden and our other members on this call is, from a technical standpoint, you understand valuation. But from a practical standpoint, how does this have an impact in real life? Imagine the people that bought this stock around $200 and $220. Maybe someone put in their retirement money, someone that worked for 15 or 20 years and took their hard-earned money and bought this stock at inflated prices. Now they're upside down by 70% because they probably didn't have the financial literacy or the technical skills to be able to do this type of work and analysis. That translates to a lot of headache, to a lot of pain, that ultimately leads to having some sort of illness. It's unhealthy. So this is part of the mission here at Romero Mentoring, which is to improve financial literacy by teaching you deep technical, hard skills that you can have a career and do this type of analysis like a real-time professional, so that you can avoid these types of mistakes and understand market cycles. Because this right here, I mean, it's a lot of pain for a lot of professional investors and also a lot of amateur first-time investors. And I can tell you, there's a camp out there that believes that this stock is going to come over here. Now, here's a short break. If you're enjoying our content, don't forget to visit our website, romeromentoring.com, and check out our starter analyst programs, where you'll learn financial modeling, investment analysis, valuation, and develop the skills professional analysts apply on the job each day. In addition to that, you'll have access to our platform and exclusive access to content relating to investing, stock analysis, opinion, and much more. Join our growing analyst community and level up your skills today. Now back to our content. There's a camp that believes this stock is going to be trading between $30 and $20 a share. And I just walked you through one method of valuation that they're using to calculate this, and that is discounted cash flow analysis. Before we wrap this up, Aiden, what do you think? What did you learn? Is this helpful? What's your take on this review of your discounted cash flow analysis?
Yeah, no, definitely. I think it's very helpful. I think especially putting the practical analysis on it, seeing the effect that it could have on someone not going through the program or hasn't experienced these skills. Because going through it myself at first, it was incredibly jarring to see that this company right now is trading at almost $60, but the valuation projects that it could be 3 to 4 times less than it is right now.
Yeah, yeah. So you're getting to see it. And again, look, I think giving you my perspective from multiple points of views, I think makes the point or solidifies the message that I'm trying to convey here. And behind this discounted cash flow analysis, Aiden built an entire financial model to project revenues, balance sheet, cash flow statement of the business, right? To be able to do this DCF analysis. He also performed valuation, right? He also spread comps. Here's some of their competitors, okay? And here's his entire valuation reference range, his football field. So these are the things that our students are starting to learn so that they can improve their professional financial literacy skill set. And this opens the door to exciting careers in finance, investing, able to make smart investing decisions that are responsible and grounded on the right information. All right, buddy? I'll end the session here, but I think this is great information, great feedback, and it's a good exercise for you to see the implications and how to use a discounted cash flow analysis to look at the market and make investment decisions like a professional. This is more taking a longer term investing approach to analyzing a company. All right. Thank you.